Well, first and foremost, thank you all for joining us on this discussion. I know a few more people will filter in, but as you could have seen from the arc of our day today, this panel is really focused on what I would call the largest, most established pools of capital in the market, as you could see by the brands which they represent, and what it's going to take to get them to commit even more to fabulous projects like the ones we've been talking about today. And with that, I'll do a very quick introduction of who we have here on the stage, and they will talk a little bit more about their funds and what they do as I direct certain questions to them. But we have Peter Anderson from LS Power, who's a managing director on the private equity team, Matthew Sweeney from Macquarie Asset Management on the private credit side, managing director as well, Dave Lynch, who's a principal in Ares Infrastructure Opportunities Fund, and Erica Vertefeuille, who is a co-founder of Terra Capital. Thank you very much for making the trip downtown today, and we're going to have fun over the next 35 to 40 minutes talking about this wonderful space. So I'm going to open up with you, Peter. After you give us maybe a brief overview of the fund you work with internally at LS Power, maybe you could start by telling us a little bit about how LS Power's approach to investing in power generation and energy infrastructure has evolved to address decarbonization goals.
Well, thank you. So I'll start with a little background on LS. So we are an energy investor and infrastructure developer. We have a couple businesses. I spend most of my time with our private equity funds. We're currently investing out of our fifth flagship vehicle, which is about $2.7 billion, with a focus on both electric infrastructure and adjacent businesses, as well as broader decarbonization businesses and assets. So really over the last, I'll say decade, it's become quite apparent to us that you cannot make these investments without considering the path that the US and the world candidly needs to be on towards decarbonization. It creates both opportunities and risks as you're evaluating everything that touches the electric grid and even a broader suite of businesses. So in the last kind of cycles that our investments have gone through, the focus on the way to risk assess that decarbonization. How do you underwrite a carbon price from a compliance perspective? How do you underwrite a carbon price from a voluntary perspective? How do you mesh all of that into your view of a transition that's happening over decades, measured in trillions of dollars? And how do you identify the winners and losers in that paradigm from an investment standpoint? That has actually become even more integrated, I'll say, with some of the voluntary opportunities that I know have been spoken about here on the stage, as EPA has pushed regulations that may require, for example, carbon capture to be put on new power generation. And when you compound that potential need for CCS with load growth and need to actually deploy, candidly, probably some more thermal generation to meet demand in the US over the next 15 years, you have to start to ask some very interesting and very difficult questions about how do you fund that infrastructure, what are the revenue streams available, and how do you start to really underwrite and monetize those offsets, the tax credits, and the other features that you may pull off of a CCS project on a power plant. That's maybe just like one example of where these intersections are starting to happen. You're also seeing it with waste and energy, water and waste, and the nexus around all of this is decarbonization. So in many ways, even without realizing it, it's become core to more or less everything we do. You can't get away from the notion of decarbonizing, you can't get away from the opportunities, nor can you get away from the risks. So it is really become a central tenet in everything we've done over the last couple of funds that we've deployed.
That's great, and maybe just moving down the line, Matt, would be wonderful to hear a little bit about the work you do at Macquarie Asset Management, and then maybe talk to us a little bit about what scope does Macquarie Asset Management see for decarbonization efforts within its private credit strategy?
Yeah, thanks, Martin. And look, I'll start with a little bit of context on Macquarie. I appreciate that can be a maze for people looking from the outside in. It's a bit of a maze for us sometimes internally, finding the right teams. But I'm part of Macquarie Asset Management, so that's separate from our commodities business, it's separate from our advisory colleagues, and we split that, broadly speaking, into what we call real assets on the equity side and MAM credit. So MAM credit's a $220 billion AUM business that covers everything from the very liquid fixed income end of the spectrum through to private credit, where I sit. Private credit, of course, is a very broad space, but for us, infrastructure debt has always been a core part of that. That's where we started our private credit platform going back 13 years or so ago now. And within infrastructure debt, we see the opportunity set really revolving around three broad themes: decarbonisation, digitalisation, and demographics. For us then, decarbonisation is not just a nice part of the strategy, it's really a core component of what we're building with our private credit platform. We've got a long history in solar and wind investments, but our mandate and our view has broadened over time from viewing decarbonisation as renewable energy to being a much broader perspective of decarbonisation. So that picks up advanced recycling, it picks up battery storage, energy efficiency, and we see carbon removal as another adjacency within that. And Martin, to your question, that approach of broadening out over time, the incremental expansion has been critical to how we've built the private credit business. It's very much about looking for adjacencies, and I think that it's very much the case with carbon removal projects that we'll treat that as an adjacency from the comfort we've built around the more traditional renewable projects. I'd also say that the opportunity set we see is really mirrored in the pools of capital that we have access to that's come into the market. So we've got investment grade type capital looking for projects like senior financing on contracted solar, wind and other established renewable projects, but we've also got separate pockets of capital that are focused more on the energy transition investments or the development stage financing. So we're really seeing that merge of opportunities with capital coming into the market.
Terrific. And Dave, if you could tell us a little bit about the work you do at Ares, and then following that, given Ares' focus on climate infrastructure investments, how do you balance opportunities in established renewable energy projects versus emerging technologies like energy storage or sustainable waste management and some of the key factors around those investment decisions?
Yep, awesome. Thank you, Martin. Ares is also amazed, so let me just take a step back. And my joke is, Ares is the largest asset manager a lot of folks have never heard of. So we're approaching $500 billion under management with a global presence up and down the capital structure across every sector and industry. As Martin outlined, I focus on climate infrastructure. We have a North American OECD mandate and deploying out of a $2.5 billion vehicle. Out of our fund, we're climate infrastructure. It's extremely broad on purpose, which allows us to deploy where the opportunity set is that best meets our capital. So we talked about utility scale renewables, Apex Clean Energy, SoftBank Energy are within our portfolio. We recently invested in Gotham Greens. If folks are familiar, we're developing green hydrogen projects in the state of Texas. We're looking at carbon capture, we're investing in green fuels, so it's extremely broad across climate infrastructure. I think one thing we're seeing that's super interesting on the point of digitization, we've been selling green electrons to the tech companies for the last decade via long-term PPAs. For the last 3 or 4 years, we've been leasing data center capacity to these same companies. And now we're seeing these tech companies also wanting to buy carbon credits. And it's all based on the demand for digital and the fact that these corporates are essentially going to fall short of their stated 2030 goals given the huge demand for data that we're seeing. And so for us, what's really interesting and is absolutely a key theme is the drive for data and digital and how that's playing out throughout the entire kind of infrastructure market in ways that you wouldn't necessarily expect.
Yeah, and we're going to come back to some of those themes that you raised there. Erica, so glad to have you with us today. Would love for you to share a little bit more about what your firm does at Terra Natural, but also as a specialized investment firm, how do you approach due diligence for certain types of removal projects? Maybe you could touch upon nature-based removal projects, and you're going to get the next follow-up because we're going to snake back down the line this way. So Thank
Great,
you.
thanks Martin, thanks for having me. So Terra Natural Capital was launched back in January. We're backed by Bain Capital with the mandate to bring project finance to carbon removal projects. Identifying, I guess, a restriction in the market with most capital being deployed to date when you think about voluntary carbon market being linked to volume. Right, so if you think about who's been financing projects to date, you have classic trading houses, obviously volume core to their mandate. You have corporates who are very select corporates who are ready to underwrite risk for what is ultimately something they should be procuring. A lot of oil and gas companies, some metals companies, where commodity-like investments are sort of true to their mandate. And then you have sort of select funds as well that have been raised with corporate LP bases. They're, of course, paying in kind. We're really trying to bring traditional project finance to this market that allows us to work with developers to scale their business, scale their equity story ultimately, but also with corporates who are ready to procure in this market, right? Talked about some of the large corporates, large tech, really respecting where they should be, right, in terms of setting that demand signal on the procurement side rather than being asked to underwrite the capital at risk. Built my career in designing project finance for early commodity markets that are decarbonization linked. So essentially over the last 10 years, looking at those sort of hockey sticks of demand, whether that be electric vehicles, energy storage, renewable power, and then looking at the supply chain ahead of that, and more often than not, a lot of those areas nowhere near being ready to scale to the demand side. Things like sort of lithium in 2015, cobalt, et cetera. So taking a lot of those analogies to carbon from a due diligence standpoint, right? And there are three core areas. One being obviously what we would call technical risk for nature-based projects. That's can you get the seeds and the trees into the ground? Will the trees grow? In that area, track record is key. The professional background of that team doesn't have to be, not everyone's done an ecosystem restoration project. There's no precedent for it at the scale we're talking about that we'll need to see to meet the projected demand. So whether that's sort of teams have done a large-scale timber project or have planted 10,000 hectares of anything in Uganda, that's sort of the first check and first screen. On the market side, and that's where most investors get, I guess, the most hesitant, really understanding the demand side. The problem with the industry is that it seems like every 6 months, the demand signals are changing. So really working with corporates and basically looking them in the eye and saying, well, you need to underwrite a 5, 10, 15-year offtake from a singular project. We're going to design that project, or we're going to work with the developer to design the project around your specific needs. Lastly, regulatory risk. And that's where we're also seeing sort of cycles of change. Every couple of months, another announcement from another country in terms of setting their carbon regulation, setting their, sort of becoming Article 6 ready. That's also core to our diligence.
And just staying with that theme, Erica, how do you think about transaction sizes when you invest? And can you talk a little bit about, as a project finance provider, project debt, project equity? How do you think about the relationship between the two forms of capital? Would be great to hear how you approach both of those questions.
Yeah. So on the second one first, when we talk about the blend of financing, I think we've become comfortable just from the nature of the market today that we are putting up a large portion of the capital. I mean, we blend that backwards, and we'll talk about sort of getting these transactions ready. It's a lot of putting the pieces of the puzzle together between the corporate off-taker. We can talk a little bit of insurance's role as well. But once you kind of have that package, you've sort of sealed the zero away, you've hedged out your market risk, you've insured away your outcome risk. We, as Terra, can then turn back and start to blend that finance package out. That's often much easier as Terra than it is for an individual developer to put that package together.
Fantastic. Dave, I'd love to hear your further thoughts on, you touched upon carbon credits, but maybe to go a little bit deeper, when you're looking at the potential for a carbon removal project, how do you think about the voluntary carbon market as part of the investment strategy? It's wonderful to hear with some of these challenges with data centers and consumption and net zero goals, but these are new markets that are not very transparent, they're not very liquid, they're improving, they're moving sideways. But a lot of the developers in the room here are counting on those carbon credits as upside to their equities. So as a very proven investor in this space, what would you say to the audience on that part? Can you share with them about that part of your diligence?
Yeah, sure. Look, at the end of the day, and we debate this actively across a number of sectors, we're an equity fund targeting an equity return, so we have to take a degree of risk to get that return. I think it's about taking smart risk. And I think everything, Erica, you just touched on is true. I think it really all starts with the demand for us. I think across this sector and other sectors, projects go as offtake goes. And the stronger the offtake, the stronger financing terms you will get. That sounds extremely elementary, but it's true. And the other comment I'll make is debt isn't necessarily a good thing when you're looking to finance your project, especially in some of these nascent sectors, and private credit will kick me under the table here, right? But if you're an equity investor and you're looking at a project and you're sitting behind a bunch of debt, depending on the covenants and cure rights of that debt, that may make the equity case harder when you're diligencing a project. And so very easy for me to say that demand is key and offtake is super important. Technology risk is a given that we look at immediately as well, but just the overall capital structure, where we fit in that capital structure, and when things go wrong, how does our capital recovery look? That's going to look a lot different if we're being layered by different forms of debt versus not. So,
very, very helpful. Matt, how do you think about risk assessment and structuring for a clean energy or carbon removal project, and would also love to hear from you about the factors that make carbon removal projects more investable from your standpoint. Take those in any order you like.
Sure, thanks, Martin. So when we're looking at a decarbonisation project, whether it's traditional renewable energy, whether it's carbon removal, it's the same three broad fundamental risks that we're concerned with. And this is going to echo somewhat of what Erica was talking about a moment ago. We're first and foremost worried about, can it get established or can it get constructed? Second, once it's built, how will it perform? And then third, what market risk or pricing risk are we taking around that? Now, the more of those factors that are mitigated or that we can put some parameters around, the easier it becomes for us to bring capital into that project. And I'm certainly not suggesting that all of those elements need to be fully mitigated by any means. We're happy to take risk on those, but it's about the holistic view of that combination of factors. So to put some context around what I mean there, if we're thinking about a nature-based project, Erica mentioned track record, and I really agree with that as being a fundamental aspect. If you're comparing to a solar project, you've got years of history of people showing they can get through permitting, they can get through supply chain issues and get a project built. For something like a nature-based removal project, there isn't that same degree of history that we can point to. But if there's some acreage that's been acquired, if there's some trees that's been planted, we're starting to see a track record there. We've got a line of sight to eventually seeing cash flow generation. Likewise, if there's an offtake contract we can point to, we're taking out that element of uncertainty around where a voluntary credit's going to price 3 years, 5 years, 10 years from now. That narrows down the parameters that we've got to deal with. And then the final aspect there of performance risk, to me that's where it comes back to drawing the analogy to a solar project. Instead of looking at an irradiance study for a solar project, we're looking at historical data on how these forests will grow over time. A given species in a given region, it'll give us that parameter again of what sort of range of outcome are we looking at here. We can narrow down the the uncertainty that we're facing. Martin, to your second question on what makes a project investable. Right now, the biggest factor, and again, I'm not intending to copy all of Erica's points here, but
What happens when Erica does such a good job?
Trading off the potential upside in carbon pricing or carbon credit pricing for the certainty of having that long-term fixed price offtake makes it so much easier for us to invest and to bring capital in. For a solar project, we can take that view on merchant pricing, or we can take a view on basis risk in an offtake contract, because we have this really deep internal knowledge of power markets. We've got an established framework for how we think about and assess those risks. For carbon pricing, we just don't have that yet. There isn't the same history in the market. The prices have been volatile, so trying to take a high degree of confidence from a debt perspective in a downside assumption, as I say, 5 years from now, 10 years from now, 15 years from now, it's really challenging. That makes it difficult for us to get to a quantum that makes sense. It makes it difficult to have a degree of confidence in what that market would look like for a refi down the track. And then I think, Martin, the counter to your question, or the flip side of your question is, what makes a project uninvestable? And for me right now, the really big aspect there are binary risks. We can take a view on construction delays. We can take a view on cost overruns. But as a debt investor, what we're not really looking to do is take the binary risks like a critical permit on a single asset where the entire value of that project is contingent on that one permit. That's just not the type of risk that we're positioned to evaluate. It's not the type of risk that our investors are looking for us to put them into. Again, I draw a comparison there with science projects. We can't finance someone's science project. We can take a view on established technology being used in a novel way, but we can't go and put institutional capital against a project that's only ever operated in a demonstration lab scale setting. So I use science project in a very loose sense there, but what I mean is we need that confidence that the equipment is going to perform, that it's not an entirely novel concept that we're financing that may or may not work, or that may take 5 years longer than expected to be operational.
Erica, you want to jump in?
Yeah,
Go right for it.
Before Martin takes all my speaking points, I was going to say, I want to sort of echo and reiterate that investors are terrified about stranded assets in this market. I mean, we've seen the elephant in the room is that there's been like 3 iterations of this market in 3 years. There have been sort of institutional capital that have come in, and they've lost their shirts. Right, and so in terms of when we think about this next, and hopefully it's like the last generation of the voluntary carbon market, as we head into, I don't know, Microsoft's 2030 goals, Salesforce, big tech, we look at the oil and gas companies, really positioning, everyone knows they're short carbon, right? we really need this to work. There cannot be another headline of someone being dragged through the dirt. It is, I think, all of our day jobs is to basically look back to like the people behind us and say, it's ready now. But that sort of level of confidence to being like, you will not lose your shirt on this one, I promise. It's a lot of sort of things to bring together, whether it's the insurance piece, the corporate offtake piece, but it's coming, yeah.
Yeah, it was really good. The last panel, I thought, touched on some of those building blocks that will come into your capital stacks, hopefully. Peter, bringing it a little back to your perspective, really in private equity, before we get into the VCM, first question for you is, what unique challenges do you face in PE investments for clean energy projects, and how do you overcome them, and maybe use that as a little bit of a segue into that framework and how you think about the more VCM-oriented nature of opportunities?
Yeah, for sure. So look, I don't have a lot different to say than you just heard, right? It's the same set of risks that are consistently applied across all projects when you're looking at infrastructure and you're looking at energy. It's market risk, it's tech risk, it's track record risk or execution risk, kind of however you want to frame that one. So it's actually quite nice that you can use the same lenses to evaluate the VCM as you have with a solar project or a wind project. the risk gets more esoteric, certainly, and there is a newness to these markets that creates opportunity, ideally, but a different set of risks than more conventional infrastructure development or investment that you've seen over the last cycle. There was an analogy, I think, to cobalt or lithium, sort of like an earlier stage commodity market. I think the same exists to early stage solar or battery storage, where you were trying to put together the first contracts, you were trying to figure out the supply chains, and kind of get the different project elements put together. That's where the VCM feels like it is now. You are starting to see some more well-structured projects, some more thoughtful projects that are starting to go after the set of risks that might be described as binary or someone's committee is going to get really stuck on. And as you continue to evolve the market constructs, the understanding of what constitutes a high quality credit, and coming to sort of a market level of the ability to structure an offtake, to say a team has a track record, starts to make all of this much more investable. And it feels, at least from my perspective, like you're really on the front end of the ramp into that investability, and you are really seeing pockets of this show up where you're like, hey, that's a go project now, and 2 years ago that sector, that subvertical looked more challenging. One constraint that I feel, and I'd be curious to hear others, is one of investment size. So we have often struggled with finding a good project, really wanting to move forward with it, but it's 15 million bucks. You need to do a lot of those against $2 billion fund, $500 billion. Someone said, I don't know how many projects that is, I can't do that math. So getting to that kind of Goldilocks where you're deploying enough capital to make it matter, not deploying so much capital into a binary situation, and sort of getting the mix of all those project elements right has been quite challenging for us. And maybe I'll give a bookend example. Yeah. If you look at some of the mega carbon capture projects and sort of the transportation sequestration parts of the value chain, those feel like great projects. There's contracts, it's infrastructure, but you're deploying hundreds of millions of dollars before you know you have a go project. The total cost is measured in the billions, and the timeline is 15 years. I don't know anyone's capital who can do that, who's sitting on the stage. Maybe you guys can, I can't. That's sort of like an oil major who can warehouse that on a balance sheet. Well, they're not really going to be able to do that and push that in the right way. So you have these constraints that should start to peel down over time, but right now are making kind of finding that exact right situation a little more challenging than it should be, I think, for myself and possibly for the others on the stage with me.
I think it's a fantastic point, and maybe just building on that and getting some of the other panelists' view. What is the smaller end of relevance for you guys? So where is it the case that, it's interesting enough that you want to spend time on it, but it's also not so small and not so scalable that it'll just never work? And I think a question like that is very beneficial to the audience, because a lot of these projects are coming up the scale curve. They're probably asking themselves, when do I talk to Ares? When do I talk to Terra? When do I talk to, Macquarie? And how would you answer that question for them? Anyone can hop in on that question.
Where do I start? So we face this every day, right? Developer says, I need $10 million for, I don't know, a couple thousand hectares in some global south country. It's a lot of time and energy and work to structure that $10 million. When you talk about making that $10 million investable, it's the same amount of work to get the corporate off-taker in place, the insurance in place to do my DD on a $10 million project as it is a $50 or $75 million project. How we're approaching this is singular developers with pipeline. I think that's number one. I think once you get the first project done, do they have a strategy? Land acquisition in Brazil, as an example, right? In terms of identifying, high potential restoration lands. Have they done a land acquisition strategies before in timberlands, right? That pipeline becomes really important. That's on the developer side. On the corporate side, when we do work with corporates, they, of course, the more advanced ones, they review projects all day long. How can we now provide a dedicated finance facility against their portfolio of demand, right? So now we're walking into, yes, we'll put the hard work on the initial, how do we match the project finance with the off-take, but then it becomes repeatable and scalable quite quickly from there.
Great.
So I will react to the notion of pipelines. I think it's an important one, and that's certainly a way to get to scale. I've seen it, and Dave, I'd be curious your opinion. I've seen it go very poorly in other renewable situations where someone sits down and throws a 10 gigawatt pipeline of solar on the table, and you get 3 projects when all is said and done. So there's a big difference between high quality pipeline that is executable and gets to that scale, and something that's mostly ideas on the back of a napkin. But I do agree that's a great way to get there if the appropriate elements of team, quality of the projects, and ability to execute all kind of come together at once, which is certainly possible, but
The unicorn, yeah.
Yeah, it's interesting. We think about it as line of sight towards deployment. So to your point, and smaller is actually better when we're talking about the level of risk that we're talking about. So to your point, we don't want to come in and finance a huge multi-billion-dollar project. It's too big. It's hard to get that financed, and so smaller is actually better initially, but with line of sight to scale. And I think to your point, we've done programmatic deals in the renewable space with that very thesis. We'll, dip our toe in the water with an initial project with a great team, and that hasn't panned out. So we've done this before with, mixed degrees of success in terms of deployment. But in terms of this sector, to your point, losing your shirts, smaller is better in some respects from an equity side, if there's line of sight.
Matt, anything to add on this?
Yes, similar to what all of my fellow panelists have been saying, our approach typically is to look for opportunities to put 75 million plus to work in a given transaction. But we recognise for this sector where it's at the moment, we have to do smaller tickets for it to be relevant. So we are looking at scale over time. And to Erica's point on pipeline or to Peter's point on where that's gone wrong, our approach there is to think about what's a sensible ticket day one, and then what can we have a degree of confidence in over 12, 18, 24 months. We recognise it won't necessarily get to that $75 million number. We know that there's a lot of ways to cut a pipeline that shows exponential growth. We're not looking to back that. We're looking to say, what's a sensible profile to get from $20 million, $30 million today to ramp up to something more akin to that 75, 100 million over a reasonable time frame.
Yeah, and I think what's really interesting is it needs to get big, but there's flexibility from the starting point. And I think that point sometimes gets a little overlooked just by the community because they feel you have so much under management all the time. One other question I wanted to ask all of you is, in your institutions, you rely on investment banks and commercial banks to bring you opportunities. This market is not the same. So how do you actually go about sourcing opportunities? Do you have originators that work in-house? Do you work with the banks? I'd love to, how do we connect this community optimally to investors like yourself? What's been effective and what's needed maybe?
Everyone's looking at me. There are not a lot of active banks bringing transactions. We have worked with, we went developer first, so we screened developers for investability, and essentially found a handful that we're a small team that we would start with, and sort of back to pipeline that we could sort of back the team, their track record, and their pipeline of opportunities. So that's number one. Number two is, again, on the corporate engagement side, we're essentially a construction loan. What projects are you looking at? If they've passed your DD, that's great. That's already a checkbox, and going from there.
Yeah, I think working with corporates as sort of a first line of defense who have already screened developers is actually really interesting. And then the tongue-in-cheek comment is we do stuff like this, right? I mean, our job is to deploy capital and oversee it. So sometimes it's helpful, as much as we love our bankers and advisors, just to talk directly to developers. So.
There's not really a whole lot more for me to add on that point, but I will add one other aspect to that, and we've found law firms to be a great source of connection there. They're working with developers on negotiating these contracts, negotiating land purchase agreements. We work closely with lawyers across the spectrum. It's a great point of connectivity.
I've never met so many commercially minded lawyers in the carbon space. No offense to the lawyers in the room, but it's actually quite incredible. They're like everybody wants, from the investors to the law firms, like everyone involved in the sector, everyone generally wants it to work, right?
Yeah.
Everyone like cares about the planet and they have kids and whatnot. Anyway, the lawyers have been super a difference maker in terms of putting groups together.
So I think the last point's an important one. Everyone wants it to work. Like, that's not true of all projects in all spaces. So I would echo that. Reach into your ecosystem, whether it's the lawyers, other consultants, off-takers. We've gotten inbound leads from all of them. I will admit to getting at least one inbound lead for someone just like emailing our ir@ellispower.com. We read them. So if you have them, send them in, and obviously come talk to us after this if you have projects. I'm interested. But I think until the more traditional bank channels and financing channels pick up, it is truly reaching into the network and just getting to the right place. And it does happen. And when it shows up on our desks, I think all of the folks on the stage would take a good look at a good project.
Okay, so we have a couple minutes left. I'm happy to maybe take one or two questions from the audience, if there are any for our panelists. Yes, sir.
So one of the common consensus that I've heard, not just today as well, is the volatility of the carbon pricing for the carbon credits. And so, for example, in the EU, they have a very well-regulated system, right? Like the EU ETS system, and then they adjust the supply and demand for EU allowances and whatnot. Then you have the carbon border adjustment mechanism and so on. In the US, in the federal level, we have no regulatory framework for carbon credits because one part, it's such a new market, and as many of you stated, innovation is happening every single day. Another risk with investors, as you mentioned, is the long-term risk of the carbon credit pricing. So the ultimate question is, how do you guys think we'll reach that stability within carbon credit pricing in the long term? Do you believe it's the government's job or more so private sector job or something that will develop as more projects kind of come down the pipeline and so on?
I think it's both. So I would say in what we call high-end voluntary, like the Hermes bags of the voluntary market, the demand signal from a corporate off-taker is the only way I can see to get an investment done in that market segment. And so, yeah, I mean, the corporate has to underwrite, at the very least, the capital at risk, maybe some yield. That's great. So if the market falls over tomorrow, you're still getting your money back, right? So long as the trees grow. In the mass market, voluntary carbon market, Article 6, Paris Agreement, that will be the price support for the market, right? And that's the compliance angle. And so whether you are trading within a domestic carbon scheme or doing sort of country-to-country bilateral transactions, and hopefully that becomes sort of freely tradable under 6.4, that would be certainly how I would see that sort of price, how you can sort of forecast that price trajectory.
Yeah, I think it's interesting, right? I mean, we've talked for 40 minutes and no one's actually talked about cost of capital. All we're talking about is getting our money back in a downside case, right? So whether it comes from the government or comes from the private sector, and if we analogate this to solar and wind, whether you're underwriting this as a senior lender or as an equity provider, you're focused on the downside, right? And so it's just interesting to listen to this conversation. And if it does come from the government, that could be a blessing and the curse, right? We talked about regulatory risk and the rules of the road constantly changing. That's hard to predict, especially as an equity investor. And so, depending on the subsidy and the form of it, what's the stickiness of it longer term, and how do you underwrite to that, can be a real challenge.
So I think that's a great point, right? The government is not a panacea here. You've seen incredible volatility in the RFS and the LCFS and RGGI and CCA and CCO, every government market. I think for us, the thing that kind of underpins that de-risking is not necessarily price de-risking, but rule and ability to analyze supply and demand. So as long as you're playing with a consistent set of rules, you can come to a point of view on a market. It's when you start to have to incorporate rapidly changing sets of rules that people start to throw up their hands and say, you can't underwrite that until something else happens, which could be the government, or it could be a continued evolution of voluntary markets where there's a more standardized, well-understood set of attributes that correlate to pricing or offset quality. And as long as those rules stay stable and knowable, I think you'll see a lot more investment driving into these markets.
Well, that has brought us to time. So I want to say thank you very much to all of our panelists. Maybe a quick round of applause for their comments here today. And I would say, importantly, they should be outside milling about. So please do seek them down. And if you have any questions, or their contact information is probably pretty easy to find, ir@lspower.com. That's pretty easy. But really appreciate your time today, and thank you very much.